The stock market is the topic of today's video, and this particular video is significant because it relates to the next meeting of the Federal Reserve. As a result of the January CPI inflation numbers being the disaster that they were, the January jobs report came in hotter than expected, and the impending meeting of the Federal Reserve on March 22nd, we are going to examine what you may expect in the stock market as a result of these events. Now, because all of these things are intertwined, I'll explain how they all fit together and perhaps clear up any confusion that may have arisen. The Federal Reserve is to blame for the high rate of inflation that we are seeing today because it printed trillions of dollars. Now that things have gotten out of hand, they are making amends by increasing interest rates in an effort to reduce consumer demand. For instance, if you want to purchase a home, the majority of people will have a mortgage, and if you want to buy a property now, it is going to cost you more since interest rates are obviously higher. Prices are expected to level out because there are fewer individuals buying homes. The Consumer Price Index showed an inflation rate of 6.4% in January, which is terrible news because it indicates that the rate of inflation is no longer declining significantly. The inflation rate in December was 6.5%, and it was 6.4% in January. Therefore, this is a significant issue. Now let's take a look at the labor markets and the jobs report for the month of January. If you know anything at all about statistics, then you know that this one was crazy. According to what Wall Street anticipated, 187,000 jobs would be added, but the actual amount was 517,000, thus this was a surprise. Now that we have all the information, let's put it together. At the moment, the Federal Reserve is paying more attention to services, where the unemployment rate has been stable for a long time. How can we expect the rate of inflation in the service sector to decline when the economy is adding 517,000 jobs each month? Wage inflation is caused by a tight labor market, thus we have to boost our prices. While there's been a significant drop in inflation over the past few months, the Federal Reserve needs to take action to reduce service inflation, which hasn't decreased. This is very important because it's clear that we live in a service-based economy right now. The Federal Reserve has raised the target range for its benchmark interest rate to between 4.5 and 4.75%. The Federal Reserve is planning to raise interest rates once again in March by 0.25 percentage points, and then they are going to raise them once more in May, most likely by another 0.25 percentage points. That would bring the Fed funds rate up to 5.25, which is considered to be on the higher end of the range. Will that be a sufficient amount of height? Is this going to be tight enough to drive inflation down to 2%, given the path it is currently on? Is it enough to raise the interest rate to 5.25% and two more increments of 0.25%? Well, from my point of view, the labor market is still very tight, and when you look at the CPI inflation report for January, it barely came down from 6.5 to 6.4% month over month. So, putting everything together from my point of view, what does all this mean? It indicates that either one of two things will have to take place or that both are possibilities. This means that if the Federal Reserve raises interest rates to 5.25%, it'll have to keep them at that level for a much longer time than it had planned. We're talking about a long time, such as the Fed not changing course until well into 2024, at which point interest rates would have to rise above 5.25%, which would be disastrous for the stock market. I believe that the stock market is gradually coming to the awareness that that is what needs to happen, and the majority of investors are still in. I find it very strange that the stock market actually celebrated and went up last week. It went up before the market opened, and it went up again when bad inflation reports came out during the trading day. Therefore, the stock market celebrated the fact that inflation was decreasing at a slower rate than anticipated because this is good news in some way. Powell was quoted as saying, "We're going to react to the data," and I paraphrased his statement as saying, "So if we continue to get strong labor market reports or higher inflation reports, it may very well be the case that we have to do more and raise interest rates more than we have priced in." Did you hear that point clearly? For the month of January, there was an increase of 517,000 jobs, and inflation reports were higher than anticipated. At their most recent meeting, they made what I believe to be a grave error when they decided to prematurely slow it down to 0.25%. They would have been better off just keeping it at 0.5%. They've effectively just shot themselves in the foot with this decision. Therefore, they'll be providing an update on the terminal interest rates during the meeting that will take place in March. This is the level at which the maximum interest rate will have to be set. They had mentioned in the past that the rate was intended to be 5.25%. If the estimate for inflation in February turns out to be less than stunning, then you can anticipate an increase in that rate from 5.25 to 5.5%. If we increase it by 0.25%, it will take 3 more meetings to get there. This is all bad news, in case you haven't already guessed it. We're going to find out the hard way that this was a bear market rally, and it is now putting an end to the little mini party that we just had. It's over, and we haven't bottomed out yet. If you let yourself be fooled by the media into believing that the bull market has begun, then you might be very disappointed. If you found this video helpful, I'd greatly appreciate it if you'd click the like button and subscribe to my channel. As always, I appreciate your support.